Welcome to topic 8. This is cost volume profit analysis. In this topic, we'll start out by defining what fixed, variable, and mixed costs are. This is a super important part of the process because to get into all the analysis, we have to actually understand and separate out fixed, variable, and mixed costs. Once we've done that, we can actually start preparing the analysis, and we can do that for both a single product and for multiple product entities. Once we've done that, it is important to understand some of the limitations of CVP analysis. So some of these assumptions which sit underneath it is actually quite an important thing to be aware of, because if you're forecasting into the future and you're potentially breaking some of those assumptions, you need to know what they are. We'll look at how break-even data can get used and what sort of decisions can be made with it and why it's important. We'll also have a look at the idea of operating leverage and what it is and what it means. We'll then move to a few specific decision-making situations. So what happens if you've got a resource limitation? So we all have resource limitations. I mean, as individuals, we are limited for the most part, or all of us are. Financially, no one has unlimited amounts of money, but we all, every single one of us, have a resource limitation in time. There are obviously for different entities, different sorts of resource limitations out there. So we're going to have a look at a few of them and the decisions around that. Have a look at this idea of relevant information. So what is relevant for decision making and therefore what is irrelevant for decision making. We'll have a look at an outsourcing decision and a special order decision as well. So cost volume profit analysis is concerned with the change in profits in response to changes in sales volumes, costs, and prices. Now this is a really important thing, and it's a very mechanical relationship. Now it's really useful to understand what that relationship is and obviously the assumptions which sit underneath it, which we'll look at later. But for the most part, it holds pretty well and can give you a really good indication of where things are going. So it can help answer a range of different questions, including how many units need to be sold or services performed to break even. Now for a company or a business or a not-for-profit or whatever it may be, knowing your break-even point is crucial. It doesn't matter the industry, doesn't matter the business. That break-even point is such an important point to make, because if you don't hit that point, you're losing money. So you really want to know that target. That's got to be a first stage process to break even. Then you can look at other questions like what is the impact on profit of a change in the mix between fixed and variable costs. Depending on the type of business, they may have more variable costs associated with production, or they may be very heavily involved in the sense of a very fixed cost structure, and the delivery of an additional unit is very, very cheap. And there's pros and cons with both of those, and we'll look at that in a little while. How many units need to be sold or services performed to achieve a particular level of profit? This is in a way an extension of that first point. So break even is how many to get to a zero profit. And then you can then adjust that target profit from zero to a non-zero profit and then figure out how many units need to be sold. So you may be targeting $1 million of profit in a year, $50 million, $100 million, $10,000, whatever it happens to be. You can plug that in and figure out what that does to the quantity that you need to sell. What happens if costs go up? It could be that rent costs go up. I mean, at the moment, if anything, rent costs are likely to go down. It could be that staff costs go up. It could be insurance costs go up. It could be marketing. Whatever it happens to be, what happens if costs change? It could be fixed costs changing. It could be variable costs changing. So what does that do to the bottom line? What does that do to expectations around hitting break-even points, hitting target profits? So examining that cost behavior enables us to understand how costs change. So if you have a shop and you have a lease and you're paying $1,000 a week for that lease, doesn't matter if no one walks into the store or 100 people walk into the store each day or 1,000 people walk into the store each day, that rental cost will still be the same. But if you're paying a salesman on commission, for each dollar of sales, they get 10 cents. The more sales that take place, the higher the costs are going to be. Those are two sort of cut and dried situations. It's not always that evident. So sometimes things can be a mixed cost, and you may have to infer what the separation is from doing some sort of statistical analysis. But it's understanding how costs change with sort of output. Now, I just mentioned that output could be a main factor, and output often is a factor, but there could be other things which drive cost changes. So again, it's understanding what affects cost. The three main types of cost are fixed costs, variable costs, and mixed costs. And understanding these three cost classifications is absolutely crucial for CVP analysis. So as we get into, I suppose, the formula, don't let that scare you, because it's a fairly simple and straightforward formula. But as we get into the formula, you'll see how important it is that we've identified what these are. So fixed costs are those costs which remain the same in total regardless of the level of activity. So that $1,000 a week shop rental cost that I just talked about, that stays absolutely flat over activity. So it doesn't matter where activity goes to, what you see is this horizontal line. And that means if this is fixed cost per unit, as you produce more, fixed cost per unit drop. So a shop wants more people going through that store. They want more sales happening because that, in essence, spreads that least cost out over more activity. They want more people in. When we consider levels of activity in terms of units of output, that total fixed cost remains the same and fixed costs per unit will decrease. Flipping over to variable costs change in activity levels. So as a courier drives more, their fuel costs will go up. As you know, that shop, maybe it's not a retailer, maybe it's a takeaway store. As they sell more product, they're putting more product into it. If they're not selling it, and let's assume there's not a huge amount of wastage, or maybe it's just an even level of wastage over time, then the more they sell, the more food they need to go in. So we're assuming here that there is a linear relationship, and that as activity increases, costs go up equally. So the variable cost per unit is the same over that range of activity. So variable costs can be considered on either a total or per unit basis. Mixed costs, as the name suggests, are a mixture of fixed and variable. So there is some base amount sitting in there, and then there is an increase over time. So a classic would be some sort of sales agent salary if it has a base level and a commission on top. So the base maybe in here, this is something different. Television advertising costs and the number of times the advertisement is aired. So there's a $10,000 amount just to get it done. And then as it gets shown more, there's a variable cost for each increase in the number of times it's shown. And if you think about a lot of utility costs, there'll be a base infrastructure charge and then there'll be a usage component added on top of it. So that's a really good example. If you're paying your water bills and you happen to not be at home for the 3 months that you're getting charged for your water bill and you don't use a drop of water, there'll still be a charge of some sort there for you. Now the important thing here is what's called the relevant range. And you heard me talk about it in a way, in the same talking about over the range of activity shown here. The relevant range is the range of activity over which the cost behavior is valid. So if you imagine a lease of a shop, and they have a small shop, a small shop in a shopping mall, but they're getting a lot of turnover and they need to expand the size of their store. The rent may go from $1,000 a week to $3,000 a week if they expect activity to grow massively. That means that they can't expect that $1,000 a week rent to be the same fixed cost if the store is going to be much, much bigger and they're going to lot more people in there. So the relevant range is that range of activity over which the cost behavior is valid. So if you're trying to do these calculations out, just be aware of where the fixed costs actually are valid, where the variable costs per unit are valid. So for break-even analysis relates to the calculation of the necessary levels of activity required in order to break even in a given period. This basically means when you're not losing money. As we can see in the formula sitting there, when the revenue that they bring in is equal to your costs. So if you imagine that and you moved fixed costs and variable costs to the left-hand side, so it'd be revenue minus fixed costs minus variable costs equals 0. When all that nets out at 0, that's your break-even point. To do a lot of this, we think about what's called the contribution margin. So this is an additional concept to think about. And that name contribution is a really important kind of giveaway to what it is. So the contribution margin is calculated by deducting the total variable cost from total revenue. The contribution margin is similar, but it's just done on a per unit basis. But the idea about it is this. What contribution margin is the amount that is left after each sale that contributes to paying off your fixed cost. So if you had revenue of $10 and variable costs of $6, $4 from each sale goes to paying off your fixed cost. For a single product or service, the break-even calculation can be expressed as the fixed cost divided by contribution margin per unit, and that's it. So if we use an example to illustrate this, we have sales price per unit of $10, we have variable cost per unit of $6, and we have fixed costs of $10,000. The contribution margin is your sales price less your variable cost. And so what this is that $4 of each sale goes to paying off your fixed cost. To get the break-even quantity, it is your fixed costs divided by your contribution margin per unit. And what we're left with is 25,000 units. So 25,000 units are required in this example to break even. If you sell less than 25,000 units over whatever period of time this is, you lose money. If you sell more than 25,000 units, you make money. And it's as simple as that. Obviously, businesses aren't just trying to not lose money. They're trying to make a profit as well. And to do that, all we need to really do is add in the target profit on the numerator side. And that's pretty much it. The profit here is before tax. We're not going to look at after-tax profit in the scope of this particular subject. But if we throw in the target profit into the mix, we can adjust this very quickly and very easily. And so we take this example and we extrapolate it out for a profit figure of, let's say we want to make a $50,000 profit. The quantity for profit is the fixed cost plus profit divided by the contribution margin. And that's in dollars, which we don't want because it's not actually a dollar figure. And we end up with 15,000 units. So to make a target profit of $50,000, they've got to cover all their fixed costs and that takes them 2,500 units, and then each $4 of contribution margin per product sold after that goes to being added into this profit figure. And they need to sell, the difference between these, an additional 12,500 units to get to a target profit of $50,000. For a single product or service, the break-even calculation graphically can be expressed as this. It's linear. Total variable costs start at the origin and move up. You'll have some sort of fixed costs, which means the total costs start not at the origin, but move up at the same gradient as total variable costs. Revenue starts at the origin because you can't make revenue if you're not selling anything. Revenue starts at the origin and moves up again at a constant gradient. So the relevant range assumption is quite important in this. Obviously, that assumption can not always hold in practice, but it's a good sort of limiting assumption to work with here. Because the revenue line has a steeper gradient than costs, they will meet at some point. And that point that they meet at is the break-even point. You can obviously tell that if the total revenue line, if this gradient was not as steep as total costs, as well as the total cost or variable cost line, then total revenue would never meet and the company would never break even. And that would take place when the sales price is less than the variable cost per unit. That means the contribution margin would be negative and you'd never see them line up, which is again why it's super important to distinguish between what your variable costs are and what your fixed costs are. For multiple products or services, we need to determine the weighted average contribution margin. So each unit will have a different contribution margin. We can't separate out the fixed costs and run them both differently. We have to essentially create a single contribution margin. And to do that, we work out a weighted average contribution margin. We do that by calculating the individual product contribution margin. We then determine the proportion of total sales of each product. So we have to get some sort of sales mix. We then multiply each product contribution margin by its sales mix. And then we just add the outcome from step 3 for each product. And that will leave you with your weighted average contribution margin. And at that point, you have a single contribution margin and you can just use it just like in a single product situation. So we have a single product here. Let's just add in another product. And to do that, we will have, so this is product A, this is product B. And we're going to make a sales price. It's going to be pretty similar. We'll make it 14 and we'll make this 9. Now, the fixed cost and profit, we don't roll over. These are just a single thing. But one piece of additional information we need is we need a sales mix. So sales mix, and we'll say 40%, 60%. Now this could be any percentages, and you could have multiple, you can have more than 2 products here. This works with an infinite number of products as long as the sales mix adds to 100%. So following the steps, we calculate the individual product contribution margin. So the contribution margin is the sales minus variable costs. So $4 and $5. Just want to make that look the same, just because, no other reason. So we have $4 a unit for product A and we have $5 per unit for product B. We have the sales mix. So that would be from, historical sales data that you have internally within the company. If it's for a new product and you don't really know, then you're going to have to make some reasonable sort of guesstimate around what that's going to be. Hopefully it's relatively spot on. Then we multiply each product contribution margin by its sales mix. So we get the weighted, which is the sales mix times the contribution margin, and that should be in dollars. So we get $1.60 and $3, and we add those two together. So it's this figure over here that we want. This $4.60 is the weighted average contribution margin. So we have a single contribution margin. and the quantity to break even is then calculated the same. It's the fixed costs divided by the contribution margin. And we're going to round that up. So to break even, we would need to sell 2,174 units of both types. Now you could work out then the 40-60 split to figure out what they are, but that represents the total amount of units sold, assuming they get sold in a 40-60 split. Quantity of profit is done exactly the same as before, so equals fixed costs plus profit, so those go in the numerator, and the now weighted contribution margin is the denominator. And we round that up again, so round up. And that's in dollars, which we don't want. Still don't want. And we end up with 13,044 units in total to break even. As noted earlier on, there are some assumptions we need to take into account. So the assumptions are that we can neatly classify costs into fixed and variable. Some cases we may need to split them apart. Not always easy to do. Cost behavior is linear. You'll notice on the graph especially, but these costs move in a linear fashion. That's not always going to be the case. And if it isn't the case, then obviously the modeling of this becomes a little bit more tricky, but we're keeping it, for the scope of what we're looking at, linear. Fixed costs remain fixed over the time period and or a given range of activity. Fixed costs, even though they are called fixed, they can change. They can change over time. Leases go up and down over time. What we're saying is that over that period of time, the fixed costs are actually fixed. Similarly, variable costs can shift over time and even over relevant range. I mean, you may be able to get quantity discounts. So if you think about getting things printed, for those that ever go down to an office works or the like and get things printed, they provide quantity discounts for the more that you copy. That's the same sort of idea that we're thinking about here, so that the price to print off 1 to 10 pages is not the same price per unit that you would get for printing 10,000 pages. So you just need to be aware of what the relevant range is. And for multi-product entities, the sales mix between the products is constant. Reality, that's unlikely to be the case, but we have to assume for modeling purposes that these things are. Now, the neat thing is, if you're using a spreadsheet type program, you can run different sensitivities. You can allow different things to change in your model, and just to see what happens and what changes as you change your cost structure, you change your sales mix, just to see what that does to things. You can use this information in a whole variety of situations. To identify the number of products or services required to be sold to meet break-even or profit targets, that gives you your numbers. You can go and talk to your sales team and say, we need to sell 1,000 units this week. We need to make 50 coffees this hour. We need to sell 200 burgers today. Like whatever it happens to be, you know the numbers that you need to hit. Planning products and allocating resources by focusing on those products that contribute more to profitability. Again, the time frame of your decisions, because things which may not necessarily be that profitable now may turn out to be more profitable in the future. Depends on the sort of cycle in the product development stage. But it allows you to understand the importance of different products and different services, and to make decisions accordingly. It helps determine the impact on profit of changes in the mix of fixed and variable costs. What happens if your fixed costs go up substantially? What does that mean? How many more things do you need to sell? How can you cover that cost? Does it really just throw out your break even and you're stuffed? It helps you price products. We talked early on, for those that are in my class at the moment, we talked early on about Fire. They, as you saw in the promo videos and in the promo for the documentary, they sold out within, it may not have been minutes, but it was very, very quickly. And yet they were blowing through money like it was no one's business and they ran out. They didn't price what they were doing properly. And if you've seen the documentary, that'll make a lot of sense. Operating leverage is the mix between fixed and variable costs in the cost structure of an entity. This is just a higher level introduction, so we won't get into a huge amount of detail with it. But what it does is helps you understand how changes in sales affect profit. And what it's really getting at is, do you have more fixed costs as a proportion of your total costs, or is it more variable? If you've got a greater proportion of fixed costs in your firm or in your entity, you have a greater operating leverage, and this is more risky. And the reason why it's more risky is that fluctuations in sales lead to higher fluctuations in profits. So I think I'd use KO here, but you can think about any streaming service. The variable costs per additional customer, delivery, I would imagine are fairly small. Like, I don't know, I can't say for absolute certain, I've never seen their sort of cost structure breakdown, but I would imagine, for an additional household signing up, or not even necessarily household nowadays, just an additional tablet signing up, the cost to have that customer as part of their distribution, I would imagine would be fairly minimal to the costs of the firm. Their main costs are if they're generating content. So if they're actually going out and producing, filming the sport, paying for the filming and production and crew and hosts and all the rest of it, or if they're buying content. And again, depends on the exact nature of the contracts of the purchase, or if they're buying content, if they only have 10,000 customers versus if they have 1 million customers, the 1 million customers is a way better situation for them, because the overall costs of the operation probably won't increase that much. Whereas if they have a small number of customers, they're still paying for all those costs, and they're probably going to be out of pocket a fair way. And as we see more sort of net operations kind of springing up, I'd imagine the fixed cost structure would be a little bit high. They would be more highly operating leveraged. So it's something just to be aware of in terms of things can go really, if things go well, it can go really well, and each additional unit is contributing more. However, you need to hit that hurdle first, and that requires scale. What happens if contribution margin is a limiting factor? None of us have unlimited resources, as much as we would. I wish I had more hours in the day, especially right at the moment, but I don't. We have limited resources. So it could be that you have 10,000 machine hours available per month. Each of us is 24 hours, not that we can use it for quote unquote work. I would say productive purposes, but sleep is still a productive purpose. I mean, it helps us actually get things done the following day. In the instance where you've got a contribution margin as a limiting, when you're dealing with a limiting factor, it is not the product with the highest contribution margin that should be produced, but rather the highest contribution margin per limiting factor. So in this case, per hour. So if we have 3 different products, candles, soaps, detergent, candles at $10 contribution margin per unit, soaps 18, detergents 5. Looks like soap is a lay-down misère that's the one you use. Machine hours though, it takes soaps 4 hours to produce. These must be incredibly fancy soaps, but it takes them 4 hours to produce, whereas candles only 1. Detergents take 1.5. You divide the contribution margin per unit by the number of hours to get the contribution margin per machine hour. In this case, it's candles at $10, soap at $4.50, and detergents at $3.33. So if that's the case, you should just focus purely on candles. Now, that's when understanding the market and understanding, what drives customer choice, and do they want choice, and do you want to be too dominated by one particular product? Candles look like, from a pure financial play, if you're just worried in the short term, candles look like it. However, there are obviously other factors to consider. When we're thinking about making decisions, and I say this in the sense of, what should be the way we make decisions, or at least part of the way we make decisions and, how rational we are. But I think we all kind of understand that a lot of decision making is not necessarily rational. What it should do is involve the selection of one alternative over another. To make sure decisions are based on the right information, the following must be identified. Relevant income, relevant cost, this idea of relevant. Relevant information differs amongst alternative courses of action. An opportunity cost, before I get into this, I'll come back to relevant information. Relevant information is the thing which is different. That is what relevant is. So if something is going to be the same regardless of what you do, then it is irrelevant. And given the current situation that we're all going through at the moment, and I'll speak to this because it's one of the things I suppose we've had to make a decision on, and it's nothing business related, but it's the choice of sending my daughter to preschool. We've paid for the term. We aren't comfortable with the current, the preschool is open, but we're not necessarily comfortable with sending her at the moment for a number of different reasons. The decision about the fact that it's costing us X number of dollars per day is not a relevant piece of information. It's annoying, don't get me wrong. We're paying for something and we're not using it, and as an accountant, I'm a little bit frustrated by that. However, that is not the relevant thing because they don't pay by the day. It's paid by the term. We've paid the term. We've already agreed to do that. We have to park that piece of information and then make our decision about whether to send her or not based on the relevant things that could be happening. And I suppose the main relevant cost is, the relevant cost on us individually, the fact that we've got to, let's say hang out. That sounds really bad, hang out with her. It is kind of fun. It just means I'm often doing a lot of this stuff late at night. But there's also a relevant benefit from that because we get to hang out with them more. So, there's differences there. But what is completely irrelevant is the cost that we've already paid. It won't change whatever we do. She goes, she doesn't go. That's happened. An opportunity cost will often be relevant and need to be taken into account. And an opportunity cost, as the name suggests, it's the cost of a missed opportunity. These are the costs of foregoing benefits that would be available if the resources had been used in the next best alternative. So if you have two things you could do with your money, and one of them would have returned 2% and one of them would have returned 5%. Yes, in a year's time, and 5% is doing pretty well right at the moment, 5% is, you're 5% better off than you were at the start of the year, but you're not 5% off where you would have otherwise have been. You would have otherwise have been 2% better off. So that 2% is the opportunity cost. That is the cost of foregoing the benefit of the next best alternative. Entities will often be required as to whether to continue to produce a product component or produce a service in-house. So we're talking about outsourcing type decisions. In making these sort of decisions, it is again important to identify relevant costs. What is something that would be avoided if an outsourcing decision is accepted, and what would still be incurred regardless of the decision? Because just because you offshore production overseas, there are still going to be costs incurred that would have been incurred had you still be producing onshore. So you need to sort of work through that. But again, what you're picking up is what changes. That's the big thing between decisions. If you go down path A or path B, if regardless of the path you go down, that thing stays the same, then it is not a relevant piece of information. And finally, a special order is a one-off request from a customer that is different from the orders usually received by the entity. From a financial point of view, a major consideration is whether the entity is operating at full capacity or not. If at full capacity, if you're going to take that order on, then you've got to get rid of, well, you've either got to find some way to get additional capacity, so hire more machinery, hire more labor, whatever it happens to be, or you need to get rid of regular customers or current customers. If there is idle capacity, then only the contribution margin per unit is relevant, because the fixed costs, there's no additional fixed costs going on. So what is the contribution margin per unit? What is the additional, that marginal revenue you'll get over the marginal cost? So you're only really, from a cost point of view, taking into account variable costs. I would use airlines as an example, but they're not a great example at the moment. But it is very much driven by, do you have room? So if you've got a restaurant and it's running at capacity, and someone comes in and and it always runs at capacity. You've got there's a little ramen place near my house that, well, obviously not right at the moment, but normally would have queues out the door and always has queues out the door. I don't think they'd necessarily want to be booked out for you to book them and book at a cheaper price than what they'd normally be paying, because they would have to reject their regular customers. So you'd have to, if they're at full capacity, they're less likely to take you on. But if it's a restaurant which is open and has lots of free space available, maybe there's an option there to do a deal, because their fixed costs would happen whether you turned up or not. It is the variable cost which is a relevant thing. So in summary, we had an introduction to cost behavior. We looked at break-even analysis for single and multiple products and services. We looked at the assumptions around CVP. We talked about operating leverage, contribution margin per limiting factor. And then we looked at decision-making in a number of various contexts.